The $223 trillion question. That's the supposed risk just lurking inside a few of America's biggest banks. It's a number so big, it's almost meaningless. So today, we're going to tackle that number head on. Is it really a ticking time bomb that threatens the system? You know, the one that holds your savings, your mortgage? Or is there more to the story? And hey, before we even get to the US, just look at this. This is from a single European exchange. 49 trillion euros. That's a projection, and it's a 41% jump from the year before. So the scale we're talking about, it isn't just massive, it's global, and it is growing at a wild pace. You know this famous line from Warren Buffett. It's decades old, but it's still the go-to description for derivatives. And why? Because it's dramatic, it's scary, and it just perfectly captures the deep-seated anxiety around these incredibly complex financial tools that, like it or not, connect the entire global economy. All right, let's dive in and really tackle that headline figure. The trillion-dollar question, or I guess in this case, the $223 trillion question. What are we actually talking about here? So you've got these sensational reports out there pointing to official banking data showing that just 5 US megabanks hold about $223 trillion in derivatives. That's more than 80% of the entire US banking system. Now, the immediate fear, of course, is that this is just a giant pile of money waiting to go up in smoke. But to understand the real risk, we have to decode what that number actually represents. So, to really get a handle on the risk, we have to decode the language. We're going to break down the mechanics here, because you absolutely have to grasp the terms before we can even... At its very core, a derivative is, well, it's just a contract. Simple as that. Its value is derived from something else, an interest rate, a stock price, the price of oil, you name it. You can think of it like an insurance policy. Let's say a farmer uses a derivative to lock in a future price for their crops. That protects them if prices crash. That's called hedging. But a speculator could use the exact same contract to just bet that the price will go up. So it's the same tool, but used for two totally different reasons. And right here, this is the most crucial point of this entire conversation. That $223 trillion figure is the notional value. Let me put it this way. Imagine the notional value is the insured value of an entire neighborhood. Let's say it's $1 billion. But the actual money changing hands, the real risk, that's the market value, which is more like the insurance premiums everyone's paying. One is a measure of total scale, how big the system is, and the other is what it would cost to get out of your position today. The notional value tells you how interconnected everything is, not that there's a $223 trillion loss waiting to happen. And this table, it just perfectly illustrates how fast that scale is exploding. This is data from the CBOE exchange. In just 1 year, the average daily volume of certain options contracts jumped by over 47%. Index options up nearly 39%. So while that notional value isn't a direct measure of loss, the sheer growth and activity tells you that the system's complexity is just cranking up every single day. Okay, so if that big number isn't the bomb itself, where are the real cracks? What are the actual dangers that are keeping global regulators up at night? This visual comes from a report by the Financial Stability Board, or FSB. Think of them as the global watchdog for the financial system. And they warn that the danger isn't one big explosion. It's how a shock in one tiny corner can propagate rapidly across the entire system. So think of it less like a bomb and more like an incredibly intricate spider's web. You touch one strand, and the whole thing vibrates. Right, it is all about contagion. A problem at one firm triggers what are called margin calls, sudden demands for more cash collateral at another firm. Now, if that second firm can't pay up, it might have to dump its assets in a hurry. That's a fire sale, and that pushes down prices, which puts pressure on other firms holding those same assets. It's a domino effect that can cascade through the entire market in a matter of hours. So what are the FSB's biggest worries? Well, first, liquidity. In plain English, are firms ready for a sudden massive cash call? Second, stress testing. Are their computer models ready for a full-blown hurricane, or are they just planning for a rainy day? And finally, hidden leverage. How much risk is secretly building up in the shadows of the non-bank sector? We're talking hedge funds, private equity. These are the real fault lines. So this all leads to the big question that I'm sure you're thinking. Didn't we fix all of this after the 2008 financial crisis? Aren't we supposed to be safer now? Well, the answer is yes and no. On one hand, absolutely. Major safeguards were put in place. A lot more trades now go through central clearinghouses, which act like a firewall, and banks have to hold way more capital. But the vulnerabilities haven't disappeared. They've just changed shape. The FSB points out that risk has basically migrated from the heavily regulated banks to the less regulated non-bank world. And that high concentration risk we talked about, oh yeah, it's still very much a thing. Here's a really good way to think about it. After 2008, we built much stronger, higher walls around the banking system. But the financial plumbing inside those walls, the network of derivatives, the repo markets, the non-bank lenders, that plumbing has become infinitely more complex and tangled up. A leak today can travel in ways we've never even seen before. So, with all this mind-bending complexity, what's the solution? Well, regulators are focusing on one single core principle to try and stop the next crisis before it boils over. It all comes down to these two words: liquidity preparedness. The FSB's big 2024 report is almost entirely dedicated to this one idea. In simple terms, it's about your ability to get your hands on cash or things you can sell for cash very quickly, right when you desperately need it to meet those sudden margin calls we talked about. And this basically illustrates their game plan. They're telling these big financial firms three things. Number one, you have to actively plan for huge sudden demands for cash. Number two, your stress tests can't just be for a little market turbulence. They need to model for extreme but plausible events. And three, you need to have the cash and liquid assets ready to go before the storm hits. It's all about being prepared, not just reacting when it's too late. So we end up right back where we started, but with a much, much sharper question. The headline asks if we're sitting on a $223 trillion time bomb, but the real and frankly more unsettling question is about liquidity. In a crisis, everyone rushes for the exact same exit. They all need cash at the exact same time. The ultimate test isn't the size of that notional number. It's whether that exit door is big enough for everyone to get through when the fire alarm finally goes off.